let's talk about Asian range and Asian range liquidity. The Asian range is between the hours of 19 EST and 0 EST. Okay. In other words, let me do this, settings, scales, 12 hours, or 7 p.m. New York to 12 a.m. New York, okay, EST. So on your chart here, go and select New York, and then you can map out these lines at 7 p.m. and 12 p.m. Then you can go back to whatever your time zone is, and then you'll be able to read these. So for UTC +3, that would be 2 a.m. and 7 a.m. Okay, so you can just do it that way. That would be UTC -4 New York, mark 7 p.m. and 12 a.m. on the chart, or 19 and 0 if you're on a 24-hour clock, and then switch back. If you want to change from the 24-hour clock, right click, settings, okay, go to go to scale, and then time format at the bottom, change it from 24 hours to 12 hours. Okay, then you get PM and AM if that's what your country uses. Okay, so this is just a practical example of time-based liquidity in the market. Notice here that there is no equals, okay? A run on equals would be a run above this candle's high, correct? Right here, notice that price actually does not come up above these highs, right? So it doesn't actually liquidate the equals, the equal high and the equal low, relative equal in the market, right? It just runs above the Asian session high. This is because this marks institutional involvement, okay? This means that there's heavy area of liquidity above this high. Before this, right, when we're looking at, you know, after 12 p.m., really the hours between like 2:30 and 7 p.m. is called the central bank dealer range. This means nobody's really doing business during this time. The volume is extremely low, and you can see this representative of your spreads if you open up your trading platform, you know, between the hours of 3 and 7. You'll see that spreads are extremely wide because liquidity is so thin. Nobody's really participating in the market at that time. When Asian session comes around, a large billions of dollars are introduced into the market. Billions, because, well, a massive portion of the world is awake now doing business, and that'd be the Asian side of the world. So we mark out the high and the low, and what we're looking for here is, if we're bearish, if we have a bearish bias, we're looking for a manipulation above the high, because this is taking stops and then a push in the intended direction. In a bullish scenario, let's invert the chart. If we are bullish, we're looking for a manipulation below the low before we displace or distribute in the intended direction or the direction of our bias, okay? Again, we don't need to look at equals. We just need to look at what the high is. It's the highest point, okay? If we liquidate above here, that is not valid. We want to liquidate the external portions of the range, okay? You can see here, liquidated the low and then pushed up to take the high. You can take a trade in here to push and take out the high, but this is extremely risky because it is not with the bias. But oftentimes what you'll see is a liquidation of the low at first, and then to take the high, and then the distribution out, okay? Taking out completely, wiping out this entire Asian range. So everybody in here has gotten their orders taken out. But again, we're following our bias, so you shouldn't be trading from here up into the high. Unless you have very good risk management, you really know what you're doing, I would not suggest trading opposite of your bias. I would suggest waiting in a bearish scenario for the high to be taken and then a breakdown, or for the low to be taken in a bearish scenario, the low to be taken and then a